Have you ever taken what seemed like a simple loan only to end up in deep debt? In our video today, we are breaking down a real court case where a microfinance institution took a borrower to court over an unpaid loan even after the lender had already sold the borrower's car. So here is what happened. In November 2020, a Kenyan took a 1.3 million Kenya shilling loan from a microfinance institution. Now they put their logbook as collateral, meaning that if they defaulted their loan, the microfinance institution could sell their car to get back their money. Unfortunately, that's exactly what happened. The borrower defaulted the loan and the lender moved in fast, auctioning their car and selling it for 1.5 million Kenya shillings, which was higher than the original amount. Now, you'd think that settles it, right? Wrong. By the time the car was sold, the total amount owed had ballooned to over 2 million Kenya shillings due to interest and penalties. So even after selling the car, the lender claimed that the borrower owed them 731,722 Kenya shillings. And so they took the matter to court. Now, the borrower argued that the interest rate was excessive and that it had been moved from 14% per year to 10% every month without notice. They also said that their car had been undervalued and that it was worth 2.8 million Kenya shillings, not the 1.5 million that it had been sold for. So the borrower tried to rely on Section 44A of the Banking Act, which puts a cap on how much interest a lender can charge. But here's the twist: the court ruled that this section only applies to banks and deposit taking institutions. So that means that the microfinance institution is not one of them. The court also said that since the borrower had signed the contract, they had agreed to the terms and it was not illegal for the microfinance institution to sell the car. So the borrower ended up losing their car and being ordered to pay the 731,722 Kenya shillings plus 50,000 Kenya shillings in court costs. So what do we learn from this case? Number one is to know who you're borrowing from. So not all lenders play by the same rules, and institutions that are not regulated by the Central Bank of Kenya or don't take deposits, then laws such as the Section 44A or the Duplum rule, which limits how much interest can pile up, might not protect you. Number two, do not be fooled by small interest rates. A 10% interest per month may not sound as much, but once you realize that it adds up to over 100% per year, you realize how much it is. That is how a 1 million debt can end up being 2 million or more. And so it's up to you to do the math beyond the monthly figure. The third thing we learn is that contracts are binding. The courts may not be able to save you just because the loan terms that you got were not favorable if you already signed a contract. Before signing anything, read the fine print, or better yet, get someone who understands loans to do it for you. The fourth thing we learn is that collateral isn't a free pass. Just because your car was sold doesn't mean that it clears up your debt. If you have interest and penalties, you're going to have to pay them. And finally, if something feels off, speak up early. For example, if your loan terms change midway and it gets oppressing, raise an issue, especially in writing, as courts take documentation seriously. Bottom line, loans can be helpful, but they can also spiral fast if you're not fully aware of what you're signing up for. So before taking any loan, make sure you know who you're borrowing from, the long-term costs, and think out the worst-case scenario and see whether it's something you're willing to handle. Money254.co.ke has written on this case and other court cases that involve personal finances. Click on the link on our bio to learn.